Hi dear traders! Last week was marked by increased fears over a possible global recession due to the hawkish stance of major central banks. Against this backdrop, demand for safe haven assets, including the US dollar, was picking up. The US dollar index, which demonstrates its value against the basket of 6 major currencies, closed last week with a 0.58% gain, near 103. In his testimony to the Congress, Fed Chair Jerome Powell reiterated that the Fed may increase the rate 2 more times by the end of the year. On the economic front, the producer price index in the US showed that the services sector remained stable last month, while the manufacturing sector contracted. Yet the economy in the United States is in a much better shape than that in Europe. This is another factor to support the US currency. The euro-dollar pair lost 0.43% over the past week and slipped below the key level of 1.0900. The recent data shows that the Eurozone and Germany have already entered a technical recession, which means there have been 2 consecutive quarters of declining GDP. Friday's PMI data revealed that the German services sector eased, raising concerns about the economy of the region. On Wednesday, the euro reached a 6-month high on expectations of 2 more rate hikes by the European Central Bank this year. Inflation is still running higher than the regulator's target of 2%. Apparently, this is the only reason that keeps the euro from falling. Meanwhile, the British pound hit its highest level in 14 months, trading against the US dollar amid another rate increase by the Bank of England. However, the sterling failed to hold at the reached highs as investors got pessimistic in the face of a looming recession. On Thursday, the UK regulator unexpectedly raised the rate by 50 basis points to 5%, while markets anticipated a 25 basis point increase. The Bank of Japan is the only major central bank that keeps its monetary policy unchanged. It seems that the Japanese regulator is on the right track as inflationary pressure is declining. But despite these facts, the yen is losing ground against other currencies. In the case of the Japanese yen, carry traders are just seeking to profit from a currency with a lower interest rate rather than invest in it. The Bank of Japan keeps its rate at minus 0.10%, while the Fed has it at 5.25% and is set to lift it further. In the meantime, gold lost its shine as an alternative store of value amid aggressive policies of major central banks. Investors shifted their focus in government bonds as their yield directly depends on interest rates. By the end of the past trading week, gold was heading for the level of $1,900 per troy ounce and is likely to maintain this course in the new weekly session. Oil quotes were also affected by recession fears and expectations of monetary tightening by global central banks. Thus, Brent crude dropped to $73 per barrel, pressured by gloomy forecasts for energy demand in the challenging global economic environment. These were the trends of the last trading week, and now a new week and a new portion of macro data are ahead. Do not miss our daily news reports to be always in touch with the latest events. See you!